Hello and welcome to our Scotland and Northern Ireland Autumn Off the Road webinar. We usually take our tour around the UK in September, but this year we've decided to provide all you need directly to your screen. We're changing our tour dates for 2026 and we'll be delivering a few sessions around the UK in January, so we'll be out to see you before you've had a chance to break your New Year resolutions. Our full in-person tour will now take place in September 2026. We'll provide further details in your follow-up email with a chance to register early for the January sessions. Between now and then, we have our festival event, which will be happening on Thursday, 20th of November at the Shaw Theatre in London. If you've not already done so, you may want to consider registering for our waiting list hits. We'll send you further details in the follow-up email to this webinar. We understand that many advisors may have been unable to join us today, so this session will be available on demand at the end of the week. So if you'd like to recap or pass to a colleague, then please do so. Again, full details will be in your follow-up email. This session does qualify for structured CPD time and will supply your certificate based on your time in the session. So please do watch till the end and complete the survey. This will automatically pop up after the webinar is ended. Your CPD certificate, a copy of the slides, will be sent via email and will land in the coming days. I'll be joined today by some fantastic speakers, including AJ Bell's Investment Director, Russ Mould, Senior Technical Consultant, Josh Croft, and Investments Business Development Manager, Brian Donald. For now, however, I'll begin the session with a business update and tell you a little about what's been going on here at AJ Bell Investcentre. This first slide is just a quick snapshot for anyone new to the company joining us today. So a quick snapshot, FTSE 250 company, and the figures on the screen are for our Q3 trading update to June 2025, with assets under administration at 96.1 billion. When we issue our next set of results, fully expect we'll be through the 100 billion landmark. Looking at business performance, as you can see from the slides, the growth has been steady year-on-year organic growth, looking at the increase in the number of customers and the assets under administration. If you look back at our financial year 2024 results, you can see it's a strong set of results across the board, with the number of retail customers up 13%, assets under administration up 21%, revenue up 23%, and profit before tax up 29%. We remain just one of the few profitable platforms, which allows us to reinvest into the proposition. So you can see this next slide, you can see the increase in spend across distribution, technology, including our product development team, and very importantly, our operations support team in Manchester. The table on the left-hand side, you can see the number of calls being answered within 20 seconds and the number of emails answered within 24 hours. And this has improved, as you can see, from August 2025, with 99% of calls answered within 20 seconds and 99% of emails answered within 24 hours. The profitability, as I mentioned earlier, allows us to continue to enhance the proposition. And so this is a slide that shows all the developments that we've delivered in the last 12 to 18 months. So starting at the top left, as many of you are aware, we introduced a new client onboarding journey, and we continue to receive strong feedback on the onboarding journey. But one of the aspects that many advisors and power planners and administration staff like is the fact that it links through to the Oracle system. So the system will give you a green tick if the system recognises the seeding policy number, which means we don't need any transfer application form. If it's, for example, an older style policy that won't go through Oracle, for example, section 32, then the system will provide a red X and provide you with a pre-populated transfer application form at the end of the illustration journey. Going down to bottom left of the table, I'll just pick out a few of the different enhancements, but one that became popular for many firms was the introduction of the tiered advisor charging. So allowing you to update and amend advisor charging online, but also to build your own specific charging. Advisor charging, for example, if you wanted to have a specific charging structure for the Smith family. They could build this online and link in all the family members so that their assets and wrappers count towards the threshold that you build into the system for your tiered advisor charging. So that's proved very popular with certain advisors that have adopted that model. Come to the middle of the table, in the past we have 2 investment strategies for our SIP, and we had 4 investment strategies for our ISA. In February 2025, we increased the number of investment strategies you can hold under our GIA, so that's now also have the 4 strategies available. And due to a migration happening next year, we're also going to increase that to 4 strategies under our SIP next year. Probably look at Q2 next year, so we can also have those 4 strategies under our SIP. That also includes, under our GIA, the 4 strategies also includes entity GIAs, for example, corporate money, charities, trust investments. We've also recently introduced ring fencing of cash, and we also have online gilt dealing available. And due to popular demand for trading gilts online at £3.95, which isn't available on very many platforms at all, we also launched the gilt MPS in April 2025. We've also made it easier to link the investments into your model portfolios, whether it be regular premiums or single investments, which again also helps with phasing investments into your model portfolios. And then top right, also a very popular enhancement was doing away with the form for any benefit requests. So you can now request PCLS online, UF Plus online. So that's proven very popular as well. Developments aren't stopping there. So for the rest of this year and into 2026, these are the next developments that we're working on delivering. So we have an onshore bond, which should be launching in the next few weeks via Cunningham Assured. And again, that's been listening to advisor feedback, power planner administrative feedback that we want to enhance the wrapper availability to include onshore bonds. Going to the top middle, again, advisor feedback. We also have a project underway to streamline the auto invest and auto disinvest options on the platform as well, with the option to opt out, because that can, some advisors do prefer to keep control of where they're disinvesting from. But we have a project underway looking like it's being delivered next year for auto invest and auto disinvest, along with a simplified bed and ISA process. Going into Q2 2026, we'll also have more phase drawdown options or tailored drawdown, and again having that automated online for you as well. We've also linked to Woven Advice to help support some of the large migrations that are coming across to AJ Bell from a service perspective or cost perspective or investment flexibility. This month we've also added a link to Mabel Insights, where you can use their system to arrange some NPS comparison tools. There's also a cash flow modelling tool available at no charge to advisors. We continue to be a multi-generation savings platform with a wide range of wrappers available, with all the junior products, junior ISA, junior SIP, lifetime ISA available as well. And with the addition of onshore bonds, in the next few weeks, we have wide coverage in terms of wrapper availability. And just another recap on the AJ Bell Investcentre on the charges perspective. The first tier for SIP ISA GIA is at 0.2, and then tiering down after that, with no charge on the assets above 2 million. We also have the retirement investment account available, which is a low-cost SIP option, with no drawdown fees, and more suitable for personal pension SIPs under 200,000. Above 200,000, you'd be best for looking at the full SIP with all the investment flexibility that is offered. So we have more than 4,000 unit trusts and likes available on the platform, ETFs, investment trusts, shares, gilts, corporate bonds, so wide range of investment flexibility. We also have structured products, fixed term deposits, and we also link into some popular trustee investment plans, whether it's Prudential Guaranteed Income Plan, and also the LV guaranteed options as well. So if you require any information on the investments that are available, please do get in touch with a member of the Scotland and Northern Ireland team. Again, listen to feedback. We've got a number of business cases to continue to enhance the number of third-party MPS providers that we link to. So you can see they're all on the screen, and we've got more in the pipeline as well. So do reach out if there's one that you're interested in adding. And just a quick slide here on just a couple of little where AJ Bell is different from other platforms. The fact we can offer a gilt trading has proven very popular. As I mentioned earlier, the gilt MPS has proven popular with it launched in April 2025. All short-dated gilts, so proven very popular for your larger GIA clients with no CGT available. We also provide the option for execution-only clients. If you have clients that do want to manage some investments themselves, we can bolt on an execution-only option, which is fully visible to you on Investcentre, with the client carrying on his own trading instructions. We have a number of platform migrations on the go, and we're fully supported by our platform support team that have been in place for coming up to 4 years, that really support any firms with their migration and agree processes with them. And we can also check the assets and make sure that it can be re-registered across if that's applicable. We've also this month linked in with Woven Advice. You can pull the data from your back office, do an analysis of the fees, do a fee comparison, and can help with the product suitability reports and client communications. Because we know and we understand how time consuming the platform migration can be. So we've got 2 teams there that can really help you support and link in with AJ Bell Investcentre with the excellent service that we provide and the low cost platform. And just to finish, just a little reminder that we launched AJ Bell Touch in June this year, which is an app-based platform, really suitable for your tech-savvy, lower-value clients. Because at launch, we've launched with some multi-asset providers. But really, you would just through the AJ Bell Touch website, you would key your illustration for the client. But it really streamlines the advice process, because the proposals, so the illustration, your recommendation report, you can also attach any fund fact sheets. So that would all be sent to your client, who would then access and review the illustration, the documents you've sent them through the client app, and they'd also respond back to you entirely through the client app. So yeah, certainly for your tech savvy clients, it's certainly worth arranging a demo of the AJ Bell Touch. Because once a client has accepted your proposals through the app, they'll be able to complete their identity verification online and then proceed with the contribution with a link straight through to open banking. So really streamlining the advice process. So please do get in touch with a member of the Scotland and Northern Ireland support team if you think that AJ Bell Touch would be a good addition to what you're currently offering your clients. Thank you for listening. Now, here to set the scene today on investment markets and look at the potential outlook for economies, markets and portfolios for the remainder of 2025 is Russ Mould, Investment Director for AJ Bell.
Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to this autumnal edition of AJ Bell Off the Road. And in this brief presentation, call it 15 minutes between friends, I'm going to try and pose 5 big questions for the rest of this year, not that there's that much left of it, and therefore more pertinently for 2026 and beyond, to help you and your clients get the strategic asset allocations right that provide the best outcomes for them and fit most appropriately with their long-term strategy, time horizons, target returns, and appetite for risk. So first of all, here's very quickly the contents. So 2025, year to remember? Well, you wouldn't necessarily think so looking at some of this lot. We've got President Trump almost ruling by diktat and certainly keeping us all pretty busy on social media. Ongoing war in Eastern Europe and indeed in the Middle East. Trump's tariffs here as represented by this massive Danish container ship. Chancellor of the Exchequer Rachel Reeves reduced the tears in the House of Commons as he tries to get the UK's budget to add up. AI, here the HAL 2000 computer from Stanley Kubrick's Space Odyssey. AI continues to transfix investors in financial markets. Then in the bottom right-hand corner here, protests in France about the tatty state of the French government's finances and any attempts to fix it by raising welfare spending or cutting taxes. And that's the block everything movement on block 2. But in the same week, the unions were at it as well on the Champs-Elysees. So febrile politics, global unrest, AI potentially transformative and disruptive. You could be forgiven. It's not been much fun from an investment point of view. But actually, surprise, surprise, you'd be wrong. The FTSE All World Index here, shown in the top left, has buzzed along quite happily, recovering very rapidly from the Liberation Day falls of the 2nd of April when President Trump introduced his tariffs. Even the FTSE All World Global Government Bond Index has put on a little bit of a wiggle. Corporate and high yield debt is doing okay. Corporate particularly, we'll come back to that. And commodities index, the CRB index there, a benchmark of something like 25 or 30 commodities, that is actually at a 12-year high as well. And gold, as we all know, has ripped to a fresh all-time high of $3,800 an ounce. Doesn't look too bad, does it, under the circumstances? Which I guess perhaps to some degree plays that terrible old cliche of how markets like to climb a wall of worry. But nevertheless, as advisors, we are paid to worry about our clients and try and keep everything on the straight and narrow for them. So what are these 5 big questions that could continue to shape financial markets and lead us to think about asset allocations between the different major asset classes and what that optimal mix may be? So the first question, are equities blowing an AI bubble? Well, I asked this one because unfortunately I'm old enough to remember the technology, media and telecoms bubble of 1998 to 2000. I was a technology analyst, equity analyst at a major investment bank, sat through that, and it was great fun on the way up, unless of course you did what we did, which was call the top 6 months early and then watch the NASDAQ double. And it was pretty frightening on the way down, even if you were bearish. And there are unfortunately some uncanny echoes and similarities between what we're seeing now and what we were seeing then. On the left, a major concentration of the markets. A lot of the gains we've seen in the S&P 500 this year have come from those 7 companies, the Mag 7, Apple, Amazon, Alphabet, Microsoft, Meta, Nvidia, and Tesla. And they now represent a record high 36 or 37% of the S&P 500. The S&P 500's at record highs, a percentage of global market cap, about 65, 66%. So those 7 companies represent, what, a 1/5 of global market cap? There have been similar episodes before, and again, they were great fun on the way up. The late 60s, the mid 70s with tech stocks, the mid 70s with the Nifty 50, the late 90s with the tech stocks. But again, those episodes ultimately ended in pain. It's just, of course, that nobody knew when. Well, what's feeding this extremely exciting, potentially technological episode is artificial intelligence, generative or otherwise. And this graphic on the right-hand side shows the aggregate capital expenditure of the so-called hyperscalers, the companies who are plowing more money into this than anybody else: Alphabet, Amazon, Meta, Microsoft, and Oracle. And as you can see, their spending has more than doubled since 2023 to just $350 billion this year, and it's going to surge to $400 billion next year. These companies are being rewarded by the stock market for spending this money. So there are 2 issues now. One, what happens if spending slows down, as we see it's forecast to do so in 2027? 2, what happens if they don't get a return on that investment, which is what popped the tech bubble in 2000. So we'll need to keep an eye on both of those trends. A third thing to consider is these businesses like Alphabet, Amazon, Meta, Microsoft have all been lauded so far because they're asset light and return high. They're now becoming asset heavy businesses because they're spending all this money on data centers and buildings and parks. And also they're starting to encroach upon each other's territory for the first time. They've previously been in their own almost hermetically sealed boxes. So there are some potential challenges ahead. Is it a bubble? Kind of feels like one to me, but I was early calling it in 99, 2000, didn't do anybody much good, at least initially, but keep an eye on it. And at the moment, it feels as if spending starts to slow down, that could be when the questions start to come through. Second question, are bonds in a bear market? So we've looked at equities, now moving to fixed income. I should probably rephrase this. Are sovereign bonds in a bear market? Are developed market sovereign bonds in a bear market? On the right-hand side, you can see how government 10-year benchmark yields in the US, the UK, France, and Japan sneaking higher. Now, Japan, you can maybe argue, has got an excuse. It's actually raising interest rates and trying to normalize them after 20, 30, 40 years of zero or negative interest rates. But in the other three, bond yields have gone up, even though central banks have been cutting interest rates. That's not really supposed to happen. It's probably a reflection of two things. One, inflation expectations. Two, gathering debts. We talked about those French protests earlier and how Chancellor Reeves was in tears. President Trump with his one big beautiful bill, that looks like it's going to add to the US deficit, not decrease it, though he's determined to say that his tariffs will actually help. But at the moment, government debt to GDP is rising. Debts are rising in absolute terms. And we can see that how this starts to manifest itself on the left-hand side with the US federal debt and, more pertinently, that red line, interest payments. $1.16 trillion annualized and rising in the USA. That's a fifth of the global tax take. $3 trillion on welfare, $1 trillion on defense, $1 trillion on interest, and the money's gone. We haven't talked about anything else yet. That doesn't feel terribly sustainable to me. And so what's the plan to try and get out of it? Well, yes, you try and grow your way out of it. Trump's planning that with percent, cheap dollar, cheap oil, lower interest rates, deregulation, lower personal taxes. Chancellor Reeves is trying to pull those levers. The French are looking at it. But if it was that easy, well, good luck, it'd have been done by now. It could also, of course, be inflationary. Hence, bond markets are still on a little bit of edge here. So it's interesting. You are seeing, and also worry, as those debts gather, interest rates, payments gather, more supply. And again, as we know, generally when the supply of something goes up, its value goes down. So that's the big challenge for sovereign bonds. And in France, you're now seeing corporate, high-grade corporate bonds trade with lower yields than French government debt. So it's not a bond bear market per se. Sovereign markets do feel like they're certainly under some duress. Now, whether that means that corporate bonds represent sufficient value is a separate issue, and again, something that clients and advisors may need to address. Third question, is the dollar in decline? Well, it's an interesting chart. Look on the right-hand side here, this is from the DXY, Dixie Index. It's a basket of the dollar against 4 or 5 different major currencies, including sterling, the yen, the renminbi, and the euro, Swiss franc. And it shot up after President Trump won his second election in November, just as it did after he won his first election 4 years previously. And then on Trump's first term, dollar went down. Second term, it's sticking to the script. Why? Well, I think, when you start firing public officials because you don't like the data, you start putting pressure on central banks, you start ruling by social media posts, you start pursuing your enemies through the law or in the media, then that's not necessarily what you expect from a developed country. It's something that you would perhaps expect from a developing country, and that now may be reflected as perhaps some advisors and clients. Nobody really wants to give up on the US, because let's face it, betting against America has not been a smart thing to do for the last 150 years. But maybe at least hedge some exposure to assets and certainly hedge exposure to the dollar, or diversify away from the dollar, either through hard assets like gold, or maybe move into other areas, and we'll come on to those in a second. This chart is interesting. It may suggest that certainly in a Trumpian world, advisors, clients, investors, more nervous of owning dollar-denominated assets than they've been for some time. You can see how the chart here, the lows, before as Biden was coming in, got down to 90. This chart does go as low as 80 in the last 20 years, and indeed 60 in the 1980s. So if things really get out of hand, well, at least you know what the downside is. The peak, of course, is 160 back in 1985, just before the Plaza Accord. Now, we just talked about advisors and clients and investors maybe looking for alternatives to the US dollar. Maybe this has been one of the areas where they've been looking for a bolt hole. Emerging markets. Are they finally emerging from a 15 years of underperformance that began in 2007, 2008? On the left-hand side, we can see the MSCI emerging markets nudging towards a 4-year high. The Shanghai Composite's actually heading towards a 10-year high, and that's only within a year after an article in the pink paper described China as uninvestable. There can be no clearer example of how the cave that we enter holds that we fear to enter holds the treasure that we seek. When something's deemed uninvestable, boy, it's generally pretty cheap. Then it's a matter of looking for a catalyst. China's determination to switch away from exports and building bridges to nowhere to personal consumption and social reform, that seems to be titivating somebody's interest at least. And again, I mentioned about possible bond market in developed sovereign bonds, maybe not in emerging ones, where again, you're seeing some signs of life here. Yields are coming down, spreads are coming down, prices are going up, as there may be a little bit more value there. And don't forget, a lot of emerging markets went through their own debt problems in the late 1990s and have emerged wiser and better off for it, albeit after a very painful readjustment, the sort of painful readjustment for which there seems to be no political or public appetite in the US, the UK, France, or indeed elsewhere. So there may be somebody there. And again, weaker dollar, don't forget, generally seen as helpful for emerging markets. The past is no guarantee for the future, we must accept. But a weaker dollar, generally seen as reflationary globally, helps emerging markets, particularly those who borrowed in dollars, because it makes servicing the debts more affordable and frees up capital that can be employed domestically. So at the moment, that pitch, if we do start to see that determination to maybe hedge away from the dollar, move away from the dollar, that could be a further incremental positive for emerging markets, which are still within their historic valuation bands on an equity basis, unlike the US, which is trading in the top decile equity valuation-wise of history, where if you look at forward PE, historic PE, EBITDA, market cap to GDP, Schiller Cape, or any other metric that you care to use. Another area that's potentially helped by a weaker dollar is commodities. Now, again, the theory is, and we again must accept the past is no guarantee for the future, a weaker dollar means the commodities are cheaper for non-dollar using countries to buy because most commodities are priced in dollars, with the exception of cocoa. We've already talked about gold, and here it is again, this chart going upwards and upwards to around $3,800 an ounce. But you can still construct a case it's actually not expensive relative to its own history. Now, that's not easy to do when it generates no yield, but or cash. But looking at gold as a percentage of the average US annual disposable income, it's not anywhere near the all-time highs it reached after the last inflation and oil shock scare of the late 1970s. So you could argue that's maybe interesting that on the right-hand side, gold is at an all-time high. Gold miners absolutely nowhere near, as benchmarked by the Van Eck Gold Miners ETF, the GDJX. Yes, that red line there is actually more or less doubled this year. That's after a 15-20 year bear market, and gold miners look extremely cheap relative to gold. So if, and I stress if, you think gold is an appropriate portfolio diversifier for clients, gold miners might be one way of thinking to go in. And the gold price, why is it going up? Well, I think it's partly maybe inflationary fears, but also debt fears. If governments really do struggle to get their debts under control, then maybe the way out of it is they either inflate their way out of it or they go for yield curve control. And that's going to be not a nice place to be if there's a deluge of fresh supply. So people looking for areas of things where supply doesn't grow very quickly, and gold at barely 1 or 2% a year is definitely one of those. So again, maybe some people may feel that's suitable. If again, you take a bearish view on the dollar, you take a bearish view on bonds, there at least you maybe there is some joined up narrative there, shall we say. So conclusions really quickly. Are we now seeing a challenge to the narrative of American exceptionalism that's dominated for the last 15 or 20 years? Even in AI, don't forget, DeepSeek is out there in China. The R1 large language model release in January caused all sorts of nightmares because it completely contradicts the American AI model of more compute, more chips, more power. DeepSeek is all about open model and therefore trying to make it as cheap, energy light as possible. And that is therefore a potential big challenge to the AI narrative that is doing so much. All sorts of ramifications if the narrative of American exceptionalism comes under any short-term pressure, either for reasons of valuation, Chinese challenges, they will say presidential social media tweets. Does it have impact on the dollar, treasuries, and also does it mean that maybe people move away from large caps into small caps? If the Trump plan is to get growth going through weaker oil, weaker dollar, lower taxes, lower interest rates, and so on, that could help cyclical growth, then why pay top dollar for secular growth through AI when you can buy loads of cyclical growth dirt cheap through small caps that have been ignored for such a long period of time? Secondly, indebtedness of the West is not going away and remains a major problem. Welfare is still costing more than tax income, and that is a challenge. So therefore, do we need to keep an eye on sovereign debt? Yes. corporate debt is probably benefiting a result, but is that now spread now too narrow to compensate for the extra risks involved? Are emerging markets regaining trust, having learned the horrible lessons of their debt crisis 25, 30 years ago? Possibly. Central banks being dragged into it again, asked to cut interest rates, even when inflation's above target. Why? Help growth, try and make the debt to GDP ratios manageable, maybe take a risk with a little bit of inflation. Could that in turn be leading to a bid for real assets over paper ones, and again, taking us to commodities and gold? Those are the big issues. They're all the things that we all need to think about as we're going to 2025, the last bits of 25 and into 26, looking at between the different portfolio options of equities, fixed income, developing, commodities, real estate, and even dare we'll say cash, which is an optionality point of view, always gives us flexibility, even if inflation there would be our biggest enemy by some considerable distance. Two final trends then to watch. Russell 2000 on the left, US small caps underperformed for what feels like forever, just like gold miners, just like China, just like emerging markets. Now we're showing some signs of life. So is the narrative changing there? And on the right hand side, we're hearing an awful lot about private equity, governments, regulators encouraging people to invest in private assets. Well, after a 15-year bull run in private equity, and this is just shown by listed private equity companies, again, the definition of a bubble, you could argue, is buying into something after a period of stellar returns and expecting the same stellar returns going forwards, even though valuations are much higher. So let's see. Wouldn't be the biggest shock in the world if PE were to start to struggle. They've had a brilliant run, valuations are higher, interest rates have gone up, so the environment's very different, and yet these things are still absolutely flying. So if there is trouble from anywhere in expected left field, watch out for this, because they all need an exit, and maybe that's why they're leaning on governments and regulators to try and get more people involved, because it would provide them with some liquidity. I appreciate that's a cynical view. I appreciate private equity's had a great run, but if you do see any trouble there, then there's all sorts of ramifications for corporate bonds as well, because of so much of this stuff's been funded by cheap money, which is now no longer quite so cheap. Thank you so much for your time. I really appreciate it, and I look forward to seeing you again very soon.
Thank you, Russ. Any questions you may have from the session, please put in the chat box or complete on the feedback will automatically appear at the end of this webinar. The next up today is a firm favourite from our tours, and this very useful session has become the backbone of our on the road and off the road attenders. A much loved technical session. And today, our senior technical consultant, Josh Trough, joins us to deliver a session all about inheritance tax planning. Josh will share practical strategies to help clients navigate IHT, whilst also touching on the upcoming budget and impact on estate planning.
Thanks. Yes, so welcome to the technical part of today's webinar. I'm Joshua Croft, part of the technical team here at Investcentre. I'm just going to cover off a couple of the technical issues that have kind of been looming large in the headlines. Firstly, the issue around tax-free cash and cancellation rights, because there's been some developments in that recently. So I'll cover those off just so we know we're all in the same position of the knowledge that we've got now. And then also I'll focus on the pensions and inheritance tax, those changes obviously coming in a couple of years' time, but we're quite far down that process of actually getting it implemented. So I'll just cover off the latest in terms of where we are or where the government is with those changes. There's been a few adjustments to the initial proposals, so I'll just cover that off, and then also try and look at some planning opportunities that might potentially be available for clients who now have an issue with potentially with inheritance tax on their pension assets as well. So cancellation rights. So this stemmed from a newsletter back in December 2024, so almost a year ago now. And it came as a bit of a surprise. Essentially, HMRC communicated that they were aware some pension schemes were allowing customers, clients to return tax-free cash that they'd drawn pre-budget on the speculation that something might happen to tax-free cash during that budget, and then following the budget where obviously there were no changes to tax-free cash, people wanting to pay that money back into their pension scheme, essentially undo that tax-free cash that they've taken. HMRC announced that that isn't allowed to be done. You cannot return PCLS or tax-free cash back into a pension once it has been taken out, which came as a surprise to quite a lot in the industry, because most people worked on the assumption that cancellation rights applied to taking your pension money for the first time. So HMRC went on to say that the tax consequences of taking tax-free cash cannot be undone. So you could pay the money back into the pension, but you couldn't undo, or you couldn't get back the allowance that you'd used from that. So the lump sum allowance and the lump sum death benefit allowance. They also went on to say that any payments or paid back in would then potentially be caught by the contribution and tax-free cash recycling rules, which would lead to unauthorised payment charges as well. So yeah, as I said, this did come as a bit of a surprise, and can also, because cancellation rights aren't a HMRC area, they're obviously from FCA regulations. So the industry went back to HMRC after this announcement and asked for some further clarification, because it didn't seem to align with how the FCA's cancellation rights worked in that regard. So fast forward to September this year, so a couple of weeks ago. So it took them nearly 9 months, or bang on 9 months, to actually respond to those initial concerns. And within the new newsletter that came out in September, HMRC basically just doubled down on that position of tax-free cash cannot be returned to a pension. Those tax consequences, the associated tax consequences, cannot be undone. So any lump sum allowance that was used from that, even if you pay that money back into the pension, you don't get that allowance back again. As part of this statement, the FCA also did a linked statement as well, confirming their position, and essentially they've agreed with HMRC's stance that PCLS isn't a cancelable contract, and so it goes into COBS 15.2, which is where the cancellation rights are held in the regulations, and it says that taking PCLS isn't one of the items that's listed within there. It gives the example of joining a pension scheme or doing a pension transfer. They're cancelable contracts. So if you actually read 15.2 in the COBS manual, it does say that adjusting an existing personal pension arrangement is a cancelable contract. So what that seems to suggest is going into drawdown for the first time would be cancelable. So you could potentially undo that designation to drawdown within the 30-day cooling off period, but you couldn't undo the tax-free cash element of that crystallization as well, which kind of puts it in a strange position where you could potentially undo the designation to drawdown, but you couldn't pay the tax-free cash back. But because you can only have the tax-free cash when you do a designation to drawdown, it would then make that tax-free cash that was taken an unauthorized payment as well. So it does seem they've got themselves in a bit of a weird situation with this, but I think we are going to go back for further clarification as well, because it doesn't really seem to be the spirit of the rules, because the cancellation rights are there for someone to change their mind if circumstances arise, which should have that right to do. So just to summarise that position then, so HMRC say the tax consequences cannot be reversed even if the funds are returned back to the pension scheme, so you won't get any of that allowance back. The FCA again have clarified that PCLS isn't a cancelable element, and that's same for uncrystallised funds, pension lump sums as well, UFPLSs, they can't be paid back either. Schemes can still offer cancellation rights voluntarily, but the FCA went on to say that they need to make sure, firms need to make sure that the clients are understanding the position that they're not going to be able to get that tax-free cash entitlement back again. So yeah, as I said, it doesn't seem like a great outcome for customers. You can see why they obviously don't want people to take their tax-free cash pre-budget just on press speculation that something might happen to tax-free cash and then pay it back in after the budget's been announced. We did see a lot of that last year, and potentially we'll see it again this year, obviously with the budget at the end of November. But it doesn't seem right that people can't change their mind outside of that kind of speculation around a budget, because a pension will usually be an individual's largest asset or one of their largest assets, and taking income for the first time, taking a tax-free cash is a big decision, and you'd think there would be some circumstances where you might legitimately want to undo that transaction, but as it stands at the minute, that doesn't seem like that's going to be a possibility. So hopefully we'll see some updated guidance on this, but just to be aware that as it stands at the minute, you won't be able to return any tax-free cash that clients draw under these rules. So moving on to inheritance tax on pensions. So where we are currently, so obviously we had the budget last October where this big announcement was made, pretty big shift in policy in terms of how pensions on the death of the member. Big consequences will affect lots of individuals going forward. So we had the budget back in October. There was a short technical consultation on the initial policy announcement, which closed in January. So that was a technical consultation on how the rules will work. It wasn't should we do this or not, which I think a lot of people wanted more of that conversation with the government rather than them just ploughing ahead with these changes. So as I said, that consultation closed back in January. The response to that consultation was then published in mid-July this year, so just around the summer break time. So within that was the response, the government's response to the consultation, and also the draft legislation as well in terms of how these changes will actually be implemented. So we've got kind of the rough guide of how it's actually going to work in practice. That draft legislation had, again, a short consultation which closed mid-September. So we're awaiting the response on that one now. I think there won't be many changes to what's been drafted out already. So I think it's pretty much 90% there in terms of what's going to go ahead. The next steps we're not 100% clear on in terms of timeline. We'd expect the draft legislation to be part of the next finance bill. The finance bills usually comes out after the budget, and obviously we've got quite a late budget this year, so perhaps something before the Christmas break we'll see the actual finance bill, which contains the pension IHT legislation itself. That will then go through the parliamentary process, and it will probably become into law in the finance bill, which will go through next spring. So that's the kind of rough timeline we're working to at the minute. As I say, we're quite far down the process, so I would be surprised if there are any significant changes to what's been announced already. And then obviously once it becomes into law, it'll affect anyone who dies after 6th of April 2027. So from that point onwards, pensions will be part of an individual's estate, and then they'll be assessed for IHT and potentially have an IHT bill to pay on those amounts. So what came out, this was back in July, so the response to the initial consultation. So the government published, or HMRC published their response to the consultation, so taking on the factors that have been raised, or some of the factors. And then there was this new policy paper, which kind of goes into how the IHT is going to be collected, the actual terms of the mechanics of the process of how that's going to work. And then we also had the draft legislation. It's relatively straightforward, the legislation. There's not hundreds of pages like there can be sometimes with these things. The main thing that they're doing is adjusting the Inheritance Tax Act 1984, which is where the IHT rules are kept. And essentially, they're just adding in a section saying what's part of someone's estate when they die, and they're adding in a section to say pension schemes are included in someone's estate when they die. So it's relatively straightforward from that perspective. Obviously, it is a significant change though. So in terms of the feedback from the consultation, so it was a very well responded to consultation. I think there were around 600 replies to HMRC and the government. So coming from not just the kind of the pensions industry, the wider industry, because this affects lots of kind of legal people working in this area. Lots of the trade bodies have responded as well. I think all the responses that I've seen were very negative towards the proposals. I think it was pretty much unanimous that the industry and the wider industry affected think this is a bad idea. It's going to add lots of complexities. There was lots of replies as well, including ideas where they could still raise some money from pension death benefits, but without kind of merging the pensions and the IHT systems together, which are going to cause all the complexities. One of the changes they did make, though, following the consultation, the initial proposals were that pension schemes would be liable for the proportion of IHT, so they would have to pay it themselves. The liability would sit with the scheme administrator. It was raised by pretty much everyone responding that that was going to be pretty much unworkable, just for common sense reasons really. The pension scheme administrators aren't aware of the rest of the estate, so they don't know what the IHT liability is. You have to pay your IHT within 6 months before interest starts becoming due. So what we probably would have been in a position where pension schemes were deducting 40% for IHT before distributing death benefits in all cases, just because they didn't want to have an underpayment on it. So you would have had an absurd situation where people would be receiving 40% less of their pension death benefits, even if there wasn't an IHT issue there at all. So it was very convoluted system they had initially. So they did back down on that now, and as a result, as it says there, the personal representative now is going to be the one responsible for reporting and paying the inheritance tax, even where it's due on the pension scheme. So what this will mean is the pension will be just like any other asset that's in the estate, and it'll be the personal representative who will be in charge of collecting and paying the IHT charge. So yeah, so we've also had confirmation or clarity on what's not in scope of IHT, because under the initial proposals there was a few grey areas that weren't 100% clear. So just to confirm then, any pension benefits left to a spouse on death of the member will be excluded. So the spousal exemption will apply to pension death benefits. So anything that's left to the spouse or civil partner won't be included in the individual's estate for IHT. So the same spousal attention will apply. Dependent scheme pension as well is also not included. So this is final salary defined benefit schemes that pay a dependent's pension on the death of the initial member. They're excluded. In most cases that will be to the spouse anyway, so there'll be the spousal exemption would apply, but it will also apply to dependent children as well. So younger children who potentially inherit a pension, that will be excluded from the deceased member's estate. We've also had clarity around death in service benefits. So initially the proposal suggested that these would be included, and I think they overlooked the fact that most death in service schemes are set up as pension schemes. So the traditional group life arrangement will be a pension scheme kind of holding those benefits there, but there has been clarity that they will be excluded from the IHT through the changes. Any payments left to charities and certain registered clubs, again, the charity exemption will apply to those, so that will apply to pension scheme benefits being left to charities as well. And then also joint life annuities, there's been clarity on that. Any joint life annuity won't be included in the deceased person's estate. But outside of those 5 items, any other pension death benefits part of the estate, so they'll be assessed for IHT and potentially have an IHT bill to pay on them. Just on annuities, just to make the point, the difference between the joint life annuity and the other annuity death benefits. So the joint life annuity is where you have a life assured, and then there's a linked life assured as well. And then on the death of the first life, they pay out usually a reduced amount to that second life assured. Typically that would be to your spouse, so the spousal exemption would apply in those cases, but they have clarified that any other person who's that second life will also be have the exemption as well. So probably the most common example of this would be for unmarried couples. So if an unmarried couple set up a joint life annuity, once it passes to the second individual on the death of the first, that will be outside the scope of IHT. Potentially, technically, it would also apply to children as well. So if you set up a joint life annuity with a parent and a child, the way that it's worded says that the child, it would still be outside of the IHT scope on the death of the first individual. But I'm not sure any insurance companies would sell annuities based on that basis, because it's obviously probably not an option for them, but technically that potentially could be an option. If we look at all the other annuity death benefits, associated death benefits, so technically these are usually called annuity protection lump sum death benefits, but various providers will have different terminology for them. So this is like the value protection, so where you get back all or some of your initial annuity purchase price back paid out, and also the guarantee payment periods as well. So if you die within 3 or 5 years, they can pay you back an amount of the initial investment as well. They will be included in the individual's estate though. So any of those kind of lump sum payments that are paid back, that will have an IHT assessment, but it's the joint life annuities that won't. Death in service, so pretty straightforward. So any of those pension schemes that are death in service schemes will be excluded. The only requirement is that the individual has to be an active member of that scheme and employed in that specific employment in terms of the service. So at the point where they die, so if they die in service and the death benefit pays out to their whoever they've chosen to receive it, that will be outside the scope of IHT. So that's a specific carve out for those death in service schemes. And then just one other point on the legislation, there's a section in there about reliefs. So this is business property relief and agricultural property relief. So the draft legislation, these are specifically excluded as reliefs for pension schemes. So probably the common one we'd see of this is holding a portfolio of AIM shares that would get the BPR relief. but there's no look through in terms of the pension assets, what this is suggesting. So it's just the value of the pension scheme. There's no reliefs available on specific types of investments, so that's been specifically excluded under the draft legislation, which creates a bit of a strange anomaly, because if you had a portfolio of AIM shares within an ISA, you'd be able to apply for the business property relief, but if you had that same portfolio held within a pension, it wouldn't get the relief. So again, an inconsistency that they've created there. And as I said, the same applies to agricultural property relief as well. So if you had a SIP holding some farmland, that wouldn't benefit from any of the APR reliefs that are available. So in terms of the process for paying the inheritance tax, so this has all been confirmed in that policy paper. So HMRC used the term legal personal representative. I think they've just created that for the purposes of this, but in most part this will be the executor of the estate where there's the will, or there'll be an administrator if it's a death where that no will was involved, but HMRC refer to it as this LPR. So they're the person responsible for gathering all the information in terms of values, calculating if there is any IHT liability, actually paying that IHT liability as well. So they'll sit in the centre of the various parties and they're responsible for all those actions. An issue that has been highlighted again is that the LPR or the personal reps won't necessarily be the same people who are the beneficiaries of the pension, because they'll be the beneficiaries of the will, but they might not be the same people as the beneficiary of the pension scheme, because the pension scheme administrator has the delegation of those death benefits. So they, at the end of the day, make the decision. And it might be to different people, and it might be that the member wanted different people to have the pension scheme there. So there's going to be some back and forth between these various parties in terms of who's paying the IHT, who's paying getting this benefit, who's getting that benefit. So again, lots of complications in the systems that they've set up. And obviously the pension scheme will be paying certain amounts to HMRC in terms of income tax, and then also inheritance tax now as well under certain circumstances. And the beneficiary will be paying their income tax as well if it's a death over 75. So not a straightforward process at all, even with the amendments that they have made to it. So HMRC have set this out into kind of a 5-stage setup in terms of paying the IHT or assessing the IHT. So firstly, it's information exchange. So the executors will notify the pension scheme of the death. The pension scheme then has 4 weeks to provide a valuation. At that point as well, the pension scheme will start their death benefit distribution process, because obviously that will determine, or that could determine, if IHT is payable. If it's left to a spouse, it will be exempt, but if it's left to other individuals, there might be an IHT issue. So again, there'll be back and forth in terms of who's getting the death benefits. Once they've got all the information and the wider information, the PRs will be able to assess whether there is any IHT liability to pay. They then can pay that through their filing the inheritance tax account. So HMRC have said there's going to be additional systems set up to actually help with these transactions. But again, it's going to be a very complicated process in terms of who's paying the IHT as well, because there's various options for the personal representative in terms of who pays the scheme, and I'll come on to that. And then once the IHT bill has been settled, the idea is that the death benefits can then be distributed. And obviously, if the IHT has been paid, then the amount net of IHT will be paid out to the beneficiaries of the pension scheme, and they, if it's a death over age 75, will have to pay the income tax on that amount as well. So that's is where we have the issue of the double taxation. So 40% initially, and then 20 for a basic rate taxpayer, or 40 for higher. And if you look at the equivalent tax rate, or the effective tax rate, it comes to over kind of 52% for a basic rate taxpayer. And again, in the consultation process, everyone's highlighted that that does seem inherently unfair, but they don't seem to have shifted on that position. Stage 5, and this is from the HMRC's guidance on this, is that the amendment stage. So I think they're even acknowledging there are going to be amendments that have to be made once this has been settled, because some people won't have paid enough IHT, some people have paid IHT and income tax, and the amount that should have been deducted for IHT, then there'll be a tax refund to make on that amount. So it's, again, lots of complications, lots of back and forth. So again, everyone's still not very happy with this proposal, and there's going to be extra costs involved, because it says here it's the personal representative, but for most people they'll be hiring a solicitor to do this work on their behalf. So that's going to be extra legal fees for the estate to pay. There's lots of extra work for pension schemes as well, so they've got to staff actually doing this administrative work and things like that. So complexity and costs are the kind of the main things that we're going to get out of these changes. So as I mentioned, there's a couple of ways you can actually look at paying the inheritance tax from the pension scheme. So the first one is you can pay it from the free estate, so you don't have to use the money that's in the pension scheme to settle the pension scheme's IHT liability. So in some cases that might be the preferred option, so to use assets outside of the pension to settle the bill, and then the pension can be distributed and subject to income tax in most cases. If the personal representatives and the pension beneficiaries are different individuals, which the PRs can claim back the IHT from the pension beneficiary, which might not be as straightforward as it suggests in HMRC's guidance, but there will be a process in place to reclaim any of those funds. But you know, the PR and the beneficiaries might not even know each other, so there are again going to be complications there. The beneficiary can instruct the pension scheme administrator to pay the IHT from the pension, so that's only on the proportion that the pension scheme itself owes. So that might be a favourable option in some cases as well. They can notify the pension scheme, and then the pension scheme can deduct the money and send it directly to HMRC, and then they can pay out the remaining benefits to the individual. So it will depend on the specific circumstances whether which option is going to be better, and there'll be pros and cons to each one. And then finally, the beneficiary can choose to receive their full death benefits, pay the income tax if due on those, and then settle their IHT liability directly with HMRC. And then they'll probably be due an income tax refund on that because they would have paid income tax on the full amount that they've taken out. And then some of that should have been subject to IHT, so there'll be a refund. They'll have to go through self-assessment and claim that money back. And if they're taking the death benefits in stages through drawdown, it might be a number of years that they're claiming back that overpayment on it. So again, not the most straightforward system. Just a quick note on kind of potential planning opportunities, because I think the main, well, one of the main issues with this as well is you've got people who've in good faith built up potentially substantial pension pots, and now that's going to be subject to IHT. And once the money's in the pension, you're kind of quite limited on options in terms of actually getting the money out. So you can only really take money out of a pension through taking PCLS, tax-free cash, or taxable income. So if you wanted to draw down your pension so you have less IHT liability, you potentially going to have to pay income tax on that amount. So you're not really going to save, you know, if you're paying 40% income tax, you're not saving anything from the 40% inheritance tax that your estate's going to pay at the end. So again, quite a tricky situation. In terms of removing the money from the pension, then it's obviously in your estate. So again, only a couple of options in terms of spending it, living off the money, enjoying it, or gifting it away to the individuals while you're still living in your lifetime. Gifting again comes with various options. So you can either give it direct, which does have IHT implications as well, potentially putting it into some form of trust, so where you've got an element of control over those funds in terms of who's going to receive them and how that money's spent or distributed over time. You could also look at rewrapping it back into a pension, so making a third-party contribution to another individual, which is quite a tax-efficient way of getting the money out of your pension, because the person that you're paying into will be able to claim the tax relief as if it was their own contribution. So some quite tax-efficient strategies there. Won't spend long on this, but spending it is the option. We often talk about pensions and pensioners and Lamborghinis. It comes up as a kind of a time over time. This one I just picked in particular because if you look at the price there, it's 264,000, which is tax-free cash allowance at the minute if someone's got funds that can do that. Probably not a great strategy to buy a Lamborghini with your pension funds, because the Lamborghini, I assume, would end up in your estate anyway. But I think one point is worth thinking about is anyone who's over age 75 and who hasn't taken their tax-free cash, they might want to reassess that potentially, because effectively the tax-free cash element is lost on death because all the death benefits become taxable, which has always been the case. But now we've got the IHT implications of that as well. It makes it sort of less attractive position to leave all your money in your pension. So it might be an idea to have conversations with clients in terms of looking at that money, particularly over 75s who've never touched the tax-free cash. In terms of gifting, there's the various gift exemptions. So everyone has the 3,000 annual allowance, so 6,000 for a couple, so that can amount over time to a fairly decent level. Separately to that, there's the £250 small gift allowance, which essentially is unlimited as well, so you could give lots of different people £250. And then we've got the potentially exempt transfers and the normal expenditure out of income exemption as well. So the PET rule's fairly straightforward. So the 7-year rule. So with a potentially exempt transfer, it doesn't leave the individual's estate. It stays within the estate for that 7-year period, but the IHT due on the amount is tapered down, as you can see on the chart there. And then after that 7-year period, it's fully out of the estate. So in terms of planning with clients, this can be useful if they did want to look at reducing their IHT-able estate, doing it through gifts and starting earlier is probably a good idea here. Quickly just cover off normal expenditure out of income. So this one is slightly a more grey area because the rules aren't very well defined. So this essentially is an unlimited gift. There's no time constraints on this, so it doesn't apply for that 7-year period, but it has to meet all 3 of these criteria. So it must be from normal expenditure, which is best defined as kind of a consistent pattern of givings. So it's given out over a regular period, it's planned for over a number of years potentially, so it doesn't necessarily have to be monthly, or it could be quarterly or annually potentially. It's just you have to be able to evidence that it's part of this consistent pattern of giving. It has to be out of income and not capital, and this is probably the biggest grey area in terms of what is classed as income and what is classed as capital, and I'll come on to a couple of definitions. And there must be no impact on the individual who's making the gift on their standard of living. So again, this is quite difficult to evidence in a number of ways, and it will be the personal representatives, the executors, who have to evidence this to HMRC when they're dealing with the IHT. So record keeping is going to be really important here. So I think you can offer clients some assistance with that. That would be very useful. So in terms of giving this all to HMRC as part of the IHT process, and then at that point they determine whether it meets the exemption or not. So it's not ideal because you can't 100% guarantee it in the individual's lifetime. As I said, the definition of income is not well defined at all. This is the definition from the Inheritance Tax Manual. So it says it's not defined in the legislation. It mentions normal accountancy rules, which is a bit of a grey area, but it does say it's not the same as the income tax rules, because that's very specific on what is classed as income under the ITEPA rules. And it is income after tax as well. So in the context of a pension, in terms of drawing an income from a pension, there's obviously various options, and whether they'll meet this definition is that's like grey area, I think. So I think if you use your pension funds to buy an annuity, you're turning that capital into an income. So I think fairly clear that any gifts made from an annuity should meet this exemption. Income from drawdown is a bit more of a grey area, and then tax and annuity pretty much looks like income, so that should be okay. Drawdown, I think, again, if it's part of that regular pattern of gifting, so a set amount that's being drawn and gifted away, probably will meet the definition for the exemption. PCLS, tax-free cash, is a little bit more unclear. I think if you just took out your max tax-free cash and gifted it away, that probably wouldn't meet the definition, because that looks a bit more like withdrawing of capital and gifting it away. But if you're regularly taking tax-free cash and gifting it away, it potentially could meet that definition. So things like phased drawdown or regular UFPLS, so taking a regular amount that can meet the exemption criteria. But as I said, it is a bit of a grey area, so I'd just I'd go be cautious if you're advising on that basis. So that's pretty much everything I had to cover. Just last point, I'm sure it hasn't at the end of November, so a few weeks away now. We've had all the normal budget speculation in terms of what could be changing, what they are looking at. Lots of the think tanks coming out with their potential ideas, but it probably is safe to say no one actually knows what's going to be announced in the budget. So particularly around those issues around the cancellation rights as well. So making any speculative decisions around a potential budget announcement is probably not a good idea, particularly as you can't, well, it's been confirmed that you can't undo those changes at the minute. So it's definitely going to be a big budget. So we'll be back to report on all the announcements that are made back on the Wednesday in November. So watch out for that. So that's my time. Thank you very much. I hope that was useful. As always, please feedback any questions, any queries. If you want to get in touch about anything else, just let us know. And I'll leave you with our disclaimer slide. So thanks very much.
Thank you, Josh. Again, as I've mentioned, if you have any questions or would like specific follow-up from any of our speakers today, just ask in the chat box or on the feedback form at the end of this webinar, We'll get back to you as soon as we can. And finally, to conclude this webinar, Investment Development Manager Brian Donald will spend the last few minutes running through the AJ Bell investment range with a focus on gilts and model portfolio solutions.
Hello, I'm Brian Donald, Investment Business Development Manager here at AJ Bell, and welcome to this Off the Road session. I'm delighted to be talking to you today about the AJ Bell Gilt MPS, the latest MPS to be added to the AJ Bell range. Now, for those of you who are less familiar with AJ Bell Investments, we launched our core multi-asset fund and MPS solutions back in 2017. And we've now grown our assets to over 8 billion, gaining awards and recognition along the way for our solid track record of performance. We've now expanded our offering with the Gilt MPS that aims to capitalise on a specific investment opportunity. And we'll discuss the precise nature of that opportunity in more depth shortly. But first of all, let's have a quick recap on what gilts are and how they work. Now, gilts are another name for UK government bonds that are issued by HM Treasury. They're listed on the UK Stock Exchange, which means that they can be easily bought and sold on the secondary market. And the term gilt or gilt-edged security refers to the primary investment characteristic of gilts, which is their security. And indeed, the UK government has never failed to make a coupon payment or repay the principal on a gilt as it's fallen due. So how do they work? Well, each gilt promises to pay the holder a fixed cash payment, known as the coupon, usually every 6 months until its maturity date. And then when the gilt matures, the holder will get one final coupon payment, as well as a return of the principal. And the principal is the price that the gilt was issued at. It's also known as the par price, and is typically £100. So what makes gilts interesting to us right now? Well, right now, gilts that were issued with low coupons back when interest rates were at historic lows are available at relatively short terms to maturity in the market. And in this current higher interest rate environment, these are being sold for less than the value the UK government is going to redeem them for once they mature. And the great thing, of course, about gilts is that they are exempt from capital gains tax. It's only the coupon payments that they earn that are subject to income tax at the holder's marginal rate. So this presents a big opportunity for gilt investors, because with a low coupon gilt, the bulk of the return is going to come in the form of tax-free capital gains at redemption, as opposed to taxable interest payments. Now, we can see the benefit of investing in a low coupon gilt on a discount to par for a high rate taxpayer in this example. Here we have two fictitious gilts, purely for illustrative purposes. These both provide a 4.5% yield to maturity. But as you can see, the lower coupon gilt benefits from a bigger discount, and therefore a significant portion of the return comes from tax-free capital gain. In contrast to that, the higher coupon gilt results in more higher rate tax being paid on the income. So as a result, the after-tax yield and the tax equivalent yield are much higher on the low coupon gilt. So with this in mind, let's have a look at the Gilt MPS product that we are offering. Gilt MPS affords you the opportunity to invest in a portfolio of direct gilts for your clients without needing to worry about having the permissions and insurance in place that investing directly in gilts can involve. As you'll see from the table, the gilts that we've selected are all short dated with a low coupon and available at a good discount to their par value of £100. So investors will benefit from an attractive yield that is mainly tax-free capital gain. There's 3 portfolios to choose from in the AJ Bell Gilt MPS range. You can either buy a portfolio with 2, 3, or 4 gilt issues in it. So you can choose whichever portfolio is best suited to your client's investment time horizon. Now, this is a buy and hold strategy with the portfolios designed to be held until maturity in order to benefit from the pool to par effect. The gilts being redeemed for their par value of £100 at maturity date. As the gilts within a portfolio mature, they are going to fall out of it, and at the point when only one issue remains in a portfolio, that gilt MPS portfolio will automatically close to new business, and a new 4-issue gilt MPS portfolio will be issued. So what you get is this ladder where portfolios will shift to the left and drop out of the range with each maturity. Clients that are in the gilt MPS will have a choice as each gilt in their portfolio matures. So you'll have the option of either withdrawing the maturity proceeds, reinvesting into the remaining gilts in the portfolio, or linking to the next portfolio in a separate account. So what do the yields look like? Well, here we have the tax equivalent yields, which in this context represents the yield required from a cash deposit where interest is being charged at the investor's marginal rate that is needed to match the after-tax return from the gilt portfolio. As you can see, the gilt MPS is offering significantly higher gross equivalent yields than the rates that are currently available from fixed rate deposits, particularly for higher and additional rate taxpayers. So who's this product for? Well, the product is aimed at clients who have money on deposit outside of tax wrappers. In other words, the CGT exemption for gilts is probably of most value to investments that are held inside a general investment account. So as such, it can be positioned as an alternative to fixed rate savings accounts. Having said that, the maturity ladder approach means that it could also be useful for cash flow planning in other wrappers as well, where a predictable cash flow is needed. So example applications could be for retirement income, perhaps as part of a bucket strategy for drawdown, or education fees planning. The gilt MPS is an exclusive to the AJ Bell Investcentre platform, and with a low minimum investment of 10,000 and an investment management charge of just 0.1%, we're making this product easily accessible and low cost. So in summary, the AJ Bell Gilt MPS is a highly tax efficient investment offering attractive tax equivalent yields for higher and additional rate taxpayers when compared to fixed rate cash accounts, and all for an annual management charge of just 0.1%. So if that sounds like something you'd like to discuss in more detail, please contact your AJ Bell Business Development Manager to arrange a meeting with us. Thank you for watching.
Thank you, Brian. If you'd like to hear more on the range of investments and managed portfolios we offer, please let us know in the feedback survey at the end of Note on the chat now, and one of the team will be in touch. So that concludes our webinar for today. Thank you very much for joining us. We appreciate how busy you are, so grateful you've taken time out of your day to spend with us. As I mentioned at the start of the webinar, a final reminder that your CPD certificate, a copy of the slides, and a link to rewatch today's broadcast will follow via email in the next few days. So that's all left for me is one final thank you, and we hope to see you all at our next seminar. Bye for now.